Hello everyone, how are you? I hope all of you are doing really good. So welcome to another session of financial management theory part, and we were discussing about our chapter that is types of financing or the sources of financing, which we started in the last lecture. So we discussed about that why there is a need of the finance, because without money you cannot run a business, and there are various types of needs and the purpose, right? The time period may be different for every need, for every purpose. Some of the things will be required for a shorter period of time, some for a long period of time, some for a medium period of time, right? Accordingly, you have to select your source, that how you are going to arrange the funds for a long period, for medium term, and for the short term. Okay. So now we are coming on to the point that what are the various sources? What are the various sources? The first is the long-term sources of finance. That what are the long-term sources through which we can arrange funds, right? So they are talking about basically two types of instruments. One is the share capital and another one is the debt. So if I give you the broad outline that we have discussed in the lectures also, when we talk about the long-term sources of finance, long-term sources, so basically they are talking about two sources. One is what we call it as the equity, right? And another one is what we call it as debt. So we have discussed this many a times, the equity and debt. What is a debt? What is the equity? What is the ideal ratio between debt and equity? So we have discussed n number of times, isn't it? So equity, when we use this word, particular word equity, this consists of three things majorly, right? One is equity share capital, right, which we are going to take up in this particular lecture only. The second thing that is included is the preference share capital, and third thing here included is retained earnings, right? The third thing that is included here is retained earnings. So broadly this is the part of equity, and this is what we call it as the share capital. Both equity and preference, this is the share capital part, along with the retained earnings, we call it the total equity. Remember, in the chapter of ratio analysis I have explained in detail that what is the difference between only equity and what is equity share capital, right? When we talk about actually retained earnings is a part of equity share capital only, right? It is a part of this part. Now when we talk about debt, sir, what is there in the debt? Debt can be the debentures can be there, right? Then bank loans can be there, then bonds can be there. So all these are broadly a part of debt, right? So now we are going to quickly discuss about what are the features of each of these sources, right? What are the various features of equity share capital? And most of the things all of you already know about equity share capital, preference share capital, retained earnings, debt. Most of the things you already know. You do not need to cram each and everything. Just understand the overall crux, right? So if you are getting a theory question for, let's say, 3 marks, 4 marks, you just have to write down a few points, right? The crux thing you should know, and that should be communicated to the paper checker. That's the most important thing. So the first source that we are going to discuss about is the equity capital, or it is also known as the owner's capital. Because when we talk about equity share capital, right, a company issues a shares, right? Which company issues the shares? A public limited company may raise the funds, right? They are in need of the funds, for the funds from the promoters or from the public by the way of owner's capital or the equity capital by issuing ordinary equity shares. Why the word ordinary has been used? Because not a preference share or nothing else. Simple ordinary equity share that we are talking about, right? Now, what are the characteristics of this? It is a permanent source of capital. It is a permanent capital. This equity share, until and unless, right, the shareholders, they want their money back, this is not redeemable, right? Equity shares do not have a fixed life that after 10 years we have to give the money back. No sir, equity shareholders do not have any such condition, right? So it is a permanent source of capital that is going to be in the business for a long period of time. They are practically the owners of the company. Yes, they become the owners of the company, they become the major stakeholders in the company, and they undertake the highest risk in the company. Why they are undertaking the highest risk? For the two major reasons. If you remember the income statement, what is the income statement? The income statement says EBIT, right, minus interest on debt, right? After that what you have is the EBT, right? And from EBT what you are going to do is pay taxes here, and after taxes what is left is earnings after taxes, right? From this earnings after taxes, what you are going to pay? You are going to pay first the preference dividend. After preference dividend, what is left is the residual earnings, right? Now the equity shareholders will be paid a dividend only and only if there is this residual earnings. That is why they have the risk. What if the profits are not left? Secondly, in case the company is not able to pay off this fixed commitment of interest on debt, if the company is not having the sufficient EBIT to pay interest on debt, then who is liable to pay off this? The owners of the company, that is the equity shareholders. That is why they are having the highest risk. They are the owners, and the owners carry the highest risk. After that, equity shareholders are entitled to dividends. But which dividends? After paying off everything. If something is left here in the form of residual earnings, from here they will get dividend, right? So that is what he's saying, that they are entitled to the dividends after the income claims of other stakeholders are satisfied. After the interest has been paid on debt, after the preference shareholders have been paid the preference dividend, after that whatever is left, if there is something that is left, the equity shareholders will be paid, right? And the dividend that is paid to the equity shareholders, that is an appropriation of profit. It is not a charge against the profits. You cannot say it is the distribution of the profits after taxes and everything. Appropriation means it is the distribution of leftover profits, right? Can you claim this dividend in the income tax? No, right? So whatever the profits that you have earned after paying off taxes, after paying off everything, whatever is left with you, out of that, this is the distribution of the profits among the owners. Clear? The next one is, in the event of winding up, the ordinary shareholders can exercise their claim in the event of winding up, right? They will get the money after paying off everyone else, right? If the money is not left, they will not be paid anything. Ordinary shareholders can exercise their claim on the assets after the claims of other suppliers of capital have been met. Other suppliers means it can be the debt holders, it can be the preference shareholders, right? After everyone else has been paid, the last these ordinary equity shareholders will be paid. The cost of ordinary shareholders is the highest. Yes, the cost is the highest. Why it is the highest? Because they are carrying so much of risk. We have studied this point in the chapter of cost of equity, right? And in the capital structure also there were the points regarding this. What is that point? The point says that the equity shareholders are carrying the highest risk. So if they are carrying the highest risk, they will ask for the highest reward also. Their expectation will be very high. That is why we say the cost of equity is higher, right? So this cost is defined by what? We have already studied the KE, cost of equity shares, right? That is the highest because they are carrying the highest risk. So ordinary shareholder capital also provides a security to the other suppliers of funds. Now, if you are a single owner in the company, let's say you are the only person in the company and you go to the bank and ask for a loan, the bank will be hesitant in providing the loan. ठीक है ना? Why? The bank says there is only one person. in case the company fails, this person is not going to pay the loan back. Now, the second situation, if there are 100 people who are the owners of the company, the bank will happily give the loan. He says if somehow the company fails, if we are not able to recover from one person's property, we are having 100 people who will together will be able to pay at least some debt. So that is kind of a security to the bank that there are 100 people who will be paying the debt in case of any failure, right? Against just one person who is ready to pay. Clear? So that is how this equity shares provide security to the other suppliers of the funds. Other suppliers, basically the debt funds, right? Here when we talk about other suppliers, it is mainly the debt part, mainly the debt suppliers, because paying to the debt supplier is of the utmost priority. That is the most important thing, right? So what are the advantages? It is a permanent source of finance. That is, there is nothing like that you have to redeem the capital after some certain point of time. It increases the company's financial base, right? Because how it increases the company's financial base? One, you can take up the funds in the form of equity. Secondly, it provides security to the debt holders, right? So you can easily raise the finance as debt also. So it helps in increasing the company's financial base. ज्यादा फाइनेंस हो सकता है कंपनी के पास. कैसे? एक तो इक्विटी की फॉर्म में, दूसरा डेट होल्डर्स थोड़ा सा सेफ फील करेंगे. बैंक पर्सन विल फील कंपैरेटिवली सेफर दैट ओके आई कैन गिव लोन. तो उतना ज्यादा फाइनेंस कंपनी के पास हो सकता है. सिंपल. अ कंपनी इज नॉट ऑब्लाइज्ड legally to pay dividends. It is not necessary to pay dividends to the equity shareholders. It is not obligatory under any law, right? So in case of uncertainties, in case the company is not having the sufficient funds, the dividends will not be paid, and the dividends will not be cumulative. Right? Cumulative means it is not like in particular year you have a loss, so you say we will pay dividend, but in the next years let's accumulate this. ठीक है ना? इकट्ठा करते जाएंगे एक साल का. इस साल का नहीं दिया, इस साल का अगले साल में दे देंगे, साथ में दे देंगे 2 साल का. नहीं. If you do not have the profits, you are not going to pay dividends. Simple. Next year, if you will have profits, then you will see if you can pay dividend. Clear? A company can further increase the share capital by initiating a right issue. That is one thing, that you can give a right issue. That is one thing. Otherwise, the first 3 points will be sufficient. Now, what are the disadvantages? Disadvantages are riskier. Definitely risk is there, because there is no certainty that the dividend will be paid, and secondly they are carrying the risk of that in case of any failure they will be the ones who will be taking up the responsibility of paying the interest on debt, right? So obviously the risk factor is there. The issue of new equity share reduces the EPS, earnings per share, of the existing shareholders. Now this is interesting. He says, what will happen, sir, if you issue new shares? For example, currently you have the residual earnings. You have the residual earnings of, let's say, 10 lakh rupees or 1 lakh rupees, right? And the number of equity shares are 10,000. So what will be the EPS here? The EPS here will be 10 rupees. Any doubts? Now he says, if there is no change in the earnings, if the earnings do not increase, the earnings remain 1 lakh, but you issue new shares and the number of equity share now increases to 20,000. So what will happen, sir? The earnings per share will reduce. The shareholders, the existing holders will not be happy. Earlier they were getting 10 rupees as dividend for every share that they were holding. Now they will be getting rupees 5 because there are more people in the queue now, right? So this will lead to what? This number of new shares, if the EPS is reduced, this will impact the company image. Impact on company's image will be there, right? And secondly, if you issue new shares, it will lead to the dilution of control. Dilution of control. Now I am the only person in the company, right? And I am having 100% control on the company. Now if I get 5 people with me obviously I cannot have 100% control. I will have to give some part of the control to those 5 people who are the equity shareholders. They have also invested money. If I have invested money, they have also invested money. They need control in the company. They are the owner. They are also the owners in the company, right? So that is why it will lead to the dilution of control. So that is again a disadvantage. Clear? Reduce the ownership and control of the existing shareholders. So this is all about the equity shares. We have highlighted only the crux point which you have to remember in the examination, and if you remember these crux point, you will be able to write it out. Okay. Okay, the next one is the preference share capital. Now, what are the features of the preference share capital? Now, preference share capital can be raised through a public issue of the shares, right? They are normally cumulative. What is cumulative? That is, for example, in year number 1, you are having a loss of 1 lakh rupees, right? So, will you pay preference dividend out of it? No, sir. You will not pay preference dividend out of it. Right? If you have a loss, then you cannot pay preference dividend. Let's say the dividend here is 2000 rupees, but now you cannot pay because you are into losses. In the year 2, let's say you have a profit of 1 lakh rupees. Right? Here, what is the preference dividend that you will pay? For this particular year, you will pay 2000 plus this 2000 also you will pay here. Right? So that is, this is cumulative. This is known as cumulative preference shares, that the dividend, if not paid in a current year, in a particular year due to the losses, it will accumulate and will be paid in the years, in the coming years when the company will be having the profits. Clear? Okay, so the dividend payable in a year of loss gets carried over to the next year till there are adequate profits to pay the cumulative dividends, right? 2000 of that particular current year and 2000 of the previous year. The rate of dividend is fixed, right? Normally the rate of dividend is higher than the rate of interest on debentures because they are also the kind of owners, right? And they also carry the risk, not that much as compared to the equity shareholders, but yes, to some extent they also carry the risk of the payment. Most of the preference share these days carry a stipulation of period, and the funds have to be repaid at the end of a stipulated period. What does it mean? In the chapter cost of equity, we have discussed about redeemable preference shares. That is what is that in today's time, most of the preference shares are what? They are redeemable preference shares. Right? They are what? They are redeemable preference shares, right? So preference share capital is a hybrid form of financing. Oh, great. Hybrid form of financing. Some characteristics of the equity capital and some attributes of the debt. Some attributes of the debt capital. Right? How it is some part of the equity capital, sir? Because they are also carrying some part of the risk. They are also some type of the owners of the company. Right? They will get a dividend, but in case of loss, they will not get a dividend. And how it is similar to debt, the debt also carries a fixed rate of interest, and the preference shareholders also carry a fixed rate of dividend. So that is how it is similar to debt, right? Okay, the cumulative convertible preference shares. Cumulative convertible preference shares may also be offered, under which the shares would carry a cumulative dividend for a period of, let's say, 3 years, after which the shares are. Now, what is cumulative preference shares? That, okay, at the start of year 1, we are issuing the preference shares, right? Here, whatever is the dividend, we will take it forward. Year 2, dividend 2, year 3, let's say the dividend is 3, we will cumulate it. Now, at year 4, we will convert these preference shares into equity shares. This will be paid. This will be paid, sir. After accumulation, this will be paid. Right? But they will be converted into equity shares. Preference share capital may be redeemed at a pre-decided future date or at an earlier stage out of the profits of the company. That depends upon the company policy, that if they say that the redemption is to take place after 10 years, they can redeem it after 10 years, or if the requirement is that before 10 years, if they want to convert it or they want to redeem the preference shares, they can redeem the preference shares. So types of preference shares are given. The types of preference shares are cumulative, that is the area dividends will accumulate. Non-cumulative, no right to the area dividend. Yes, non-cumulative can also be there, that in case here you do not pay this, you only pay the current year dividend. Previous year preference dividend, if there is a loss, you are not able to pay the preference dividend, that is finished. The story is finished here, right? It is not going to get carried forward to the next year. No, right? You are going to pay only the current year when you have the profits. Simple. Redeemable, you all know. Participating, now this is interesting, but this is a very rare form of preference shares which you won't otherwise found. Participating is what? The participating is that after, out of this, where it is the EPS part I was explaining from this. Now let's say here you have an EPS of, let's say, 10 rupees. Now out of this 10 rupees you have decided to pay an equity dividend of 5 rupees. Right? Now the remaining 5 rupees, if you pay 3 rupees to preference shareholders, this is what is known as the participative, that out of the surplus funds which are left after paying off the equity dividend, if the preference shareholders have the right on that, that is known as participative preference shares, right? Okay. After that, non-participating, this is the most common form where they will get a fixed rate of dividend only, and out of the surplus funds they do not have any rights. Convertible is they can be converted into equity shares, that is after a specified period of time. They have the option of the conversion, right? Okay, what are the advantages? Advantages, no dilution in the EPS because they will be getting their own fixed rate of dividend. There is no impact on the EPS, right? Advantage of leverage because it bears a fixed charge. We have studied in the chapter of leverages that how using a fixed cost we can increase our profit. So preference dividend is also a fixed charge, sir. You will be paying, if you are paying 16% preference dividend, that is a fixed cost, right? You will be paying every time. Right, so here the leverage benefit can be there. No risk of takeover as the preference shareholders do not have the preference shareholders, they do not have the voting rights except where the dividend payment are in areas they have limited voting rights, right? So takeover by the preference shareholders is not an option. Preference dividends are fixed and pre-decided, so you have to pay only a fixed percentage to the preference shareholders, right? Preference capital can be redeemed after a specified period, so this is the capital that you can redeem after a specified period, right? You can pay back the money which you have raised. What are the disadvantages? Preference dividend, now this is the biggest disadvantage. Preference dividend is not tax deductible. Interest on debt is a tax deductible, whereas preference dividend is not a tax deductible expenditure, right? So does not provide a tax shield to the company. Preference dividends are cumulative in nature, so when you keep on accumulating the preference dividend in the year of profits, there will be a burden of paying a huge sum of dividend, right? Let's say for the 5 continuous years you are into losses, you have cumulative dividends of, let's say, 10 lakh rupees preference dividend. Now in the next year if you are earning a profit of 10 lakh rupees, that 10 lakh rupees will be gone in paying the preference dividend only, right? Because of its cumulative nature. So it will be a burden for the company at one stage when you will have to pay off the dividend. Clear? So this distinction between equity and preference share, just go through it once. Retained earnings. Retained earnings is very simple, sir. Retained earnings is what? Whatever you are earning, you do not pay 100% to the equity shareholders. You retain some money in the business, that is known as plowing back of profits, right? So retained earnings is often known as plowing back of profits, and this question has been asked as a theory. Plowing back of profits, it means that when you do not distribute 100% of the earnings to the equity shareholders, right? You hold back a certain part of the profits and you use that money for the purpose of the business, maybe for the expansion purpose, for buying a new asset, or for any other reason, right? So it is known as plowing back of the profit, is using our own profits in the business for expansion and everything, right? That is what is retained earnings. Such funds belong to the ordinary shareholders, not to the preference shareholders. Remember, retained earnings belong to the equity shareholders, right, and increase the net worth of the company, a public limited company must plow back a reasonable amount of the profit every year, keeping in view the legal requirements and also for its own expansion plans, right? So keeping in view the legal requirements as well as what are your expansion plans, they should keep some amount as the retained earnings which can be used instead of going for the debt option or other equity share capital. Why not use our own profits, sir? If you are earning profits, then why not use your own profits for the expansion for a new project, right? You can use it. That is why we have discussed about the cost of retained earnings. Right, so this is about the retained earnings. Very simple, but yes, a small part can be asked on the plowing back of profits. Clear? Then debentures, very simple. Debentures, just read it. Debentures is what? The debt carries a fixed rate of interest, right? It can be issued in the different denominations, 100 to 1000, any denominations can be there. We say 5000 debentures of 100 rupees each, 1000 rupees each, right, are issued on the basis of debenture trust deed. That is the terms and conditions. Simple. Instruments for raising the long-term debt capital, the period of maturity is 3 to 10 years. Now the debentures can also be redeemable or irredeemable. Normally they are redeemable. That is the amount of the debt that is taken, that is to be repaid after a specified period. It carries a fixed rate of interest, right, and it is comparatively a secured source of finance, because the interest on debt is to be paid whether you are earning the profits or not, whether the company is earning profits or not, right? Debentures are either secured or unsecured. That is, against the debentures you can give the security or not. They may or may not be listed on the stock exchange. The cost of capital raised through debenture is quite low, since a fixed rate of interest is to be paid, right? Interest payable on debentures can be charged as an expense before tax. So the cost is quite low. Why? Because one, there is a fixed rate of interest. Secondly, that interest is a tax deductible expenditure, so that further reduces the cost of capital, right? From the investor's point of view, the debentures offer a more attractive prospect than the preference shares, since the interest on debenture is payable whether or not the company makes profit. Now this is one very important point, that in case of preference share capital, the company is not liable to pay dividends if the company is not earning profits. But in case of debentures, even if the company is into losses, the company is liable to pay interest on debt. That is a very important part, right? So debentures can be non-convertible debentures, right? That is the debentures which cannot be converted into equity shares or anything. Fully convertible, which can be converted into equity shares after a specified period, and partly convertible, right? That some part of the debentures can be converted and some cannot be converted. So that depends from company to company. Types of debentures, just go through with it. What are the advantages? The biggest advantage is interest is a tax deductible expenditure, right? Interest is tax deductible. This is one of the biggest advantages, right? Investors consider the debenture investors safer than equity or preferred investment, and hence may require a low return on the debenture investment. Financing does not result in the dilution of control, because the debenture holders, they are not the owners of the company, so there is no dilution of control. Safer option. In a period of rising prices, the debenture issue is advantageous because you have to pay only a fixed rate of interest only and nothing more, nothing less, right? Disadvantages: debenture interest and the repayment of principal is an obligatory payment. You have to pay even if you are into losses. The protective covenants, forget about this point, you won't be able to remember it, so I don't want to take up. Right? Protective covenants means the securities which you have given, they might be restrictive, that the bank can use the security for this purpose, or this not purpose, they cannot use it. So forget about it, nothing to worry. Debenture financing enhances the financial risk associated by the firm. Yes, that is a financial risk will increase. Since the debentures need to be paid at the time of maturity, a large amount of cash outflow is needed at that time. That if the debentures are to be redeemed, let's say after 10 years you have to redeem the debentures. So after 10 years you will have to have a huge sum to pay back that amount of debentures, right? So that is kind of a disadvantage. Clear? Just difference between preference shares and debentures, just go through it with simple. So in the next lecture now we will take up this discussion on the bonds, right? That is also a kind of debt. And some of the bonds we will be discussing, some of the bonds are not that important or never have been asked, so I'll just skip it. Masala bond is important. Loan from financial institutions, this will not be take up because this has never been asked, right? That what are the financial institutions, year of establishment, not relevant from our point of view, right? So simply we'll have some discussion on the bonds here and some discussion later on also we have the bonds will take up. Then bridge financing is important. Venture capital financing, definitely it's important, sir. That what is venture capital? Debt securitization, yes. Short notes, you will be asked short notes on this, right? So nothing to worry, nothing to like you have to go cram and everything, no. Lease financing, operating lease, financial lease, we will be discussing about the things. So in the next video we will take up about the bonds first, right? Okay, so please revise up till this point whatever we have done in this particular lecture, that is equity share capital, preference share capital, retained earnings and the debt, these 4 parts. Please revise it thoroughly before the next one. See you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.